Okay, let's unpack this. Have you ever found yourself, sifting through stacks of financial documents or maybe dense tax codes, wishing there was just a clearer, more structured way to grasp the nitty-gritty without getting completely overwhelmed?
Mm.
Well, today, you're in luck. We're embarking on a comprehensive, exam-oriented deep dive into a crucial, often misunderstood area of direct tax laws, income from other sources.
Indeed. And this head of income, it's frequently termed the residuary head. It acts as like the ultimate tax net. It captures all those taxable profits, gains, and incomes that just don't neatly fit into the more common
Like
categories.
salaries, house property.
Exactly, or business profits, capital gains. Our mission today really is to give you an exhaustive exploration of this section's nuances. We want to make sure you grasp every concept, every detail needed to tackle even the most intricate application-based questions you might face.
Right.
We'll follow the logical flow of the material, aiming for absolute clarity and depth. Really prepare you for true mastery.
Think of this as your essential roadmap, maybe, to becoming truly well-informed. We're hoping it's packed with surprising facts and just enough insights to keep you hooked.
Absolutely.
We're going to dissect complex provisions, explain the underlying why behind them, especially those anti-avoidance measures, and arm you with practical examples to really solidify your understanding. So grab your virtual notepad, because we're about to thoroughly explore the fascinating world of what counts as other income for tax purposes, giving you the detailed knowledge you need. All right, let's start by laying the essential groundwork. When we talk about income from other sources, or IFO for short, what are we fundamentally discussing?
Well, it's essentially the income category that serves as a catch-all. That's the simplest way to think about it. It's designed to scoop up any income, profit, or gain that the tax authorities, don't want slipping through the cracks. If it doesn't fit neatly into the specific heads of income salaries, income from house, property, profits and gains from business or profession, which we often just call PGBP.
All right, PGBP, or capital gains.
Precisely. If it's not under one of those, then by default, it lands right here under IFOs.
Okay.
And that residuary nature of IFOs, it's absolutely critical to the whole architecture of the Income Tax Act 1961. The legislative intent behind it is crystal clear. Make sure no taxable income escapes the net just because it doesn't align perfectly with one of the more specific categories.
It's a foundational principle then.
It really is. Covering all potential income streams, making the act truly comprehensive. Without IFS, clever folks might find ways to structure income to avoid tax, and this section basically closes that door.
So it's the ultimate safety net for the tax department. But how exactly do we calculate this income? Are we talking about when the cash actually hits your bank account, or is it more about when the income is earned regardless of payment? Because those two can be very different, can't they?
They certainly can be, and Section 145 gives us the clarity there. Income chargeable under IFOs must be computed based on either the cash system or the mercantile system, which is also known as the accrual system of accounting. Okay.
The key thing is, whichever system you choose, it must be the one regularly employed by you, the SSE, the taxpayer.
Right. Consistency matters.
Exactly.
Yeah.
So if you consistently use the cash method, your IFOS is based on actual cash receipts. If you use the mercantile system, it's about when the income accrues or becomes due, even if the cash hasn't changed hands yet. It just ensures consistency in how your income is recognized year after year.
That makes sense. But I've also heard about something called ICDS, the Income Computation and Disclosure Standards. How do those fit into this picture, especially with the cash versus mercantile systems?
That's an excellent point. It's a layer of, complexity added by Section 145, too. The central government is empowered to notify these Income Computation and Disclosure Standards, or ICDS.
Okay.
What's important here is that 10 specific ICDSs have been formally notified, and these standards are designed to be followed by all assessees. There's very narrow exception for individuals or Hindu undivided families, HUFs, that aren't required to get their accounts audited under Section 44AB.
But for most others. For pretty much everyone else, especially those following the mercantile system, these standards apply for computing income under both PGBP and income from other sources.
Both heads.
Interesting.
Yes. They essentially standardize how certain incomes and expenses are recognized for tax purposes.
Yeah.
It ensures uniformity and prevents, let's say, manipulation, particularly when dealing with complex financial transactions.
Okay, here's where it gets really intricate and frankly quite clever from a legislative standpoint. When you hear dividend, Most of us, immediately picture a straightforward cash payout from a company, right?
The classic dividend check.
Exactly.
Right.
But for tax purposes, the definition is far, far wider than that conventional understanding, especially when we talk about these deemed dividends. It seems like a classic case of tax law looking beyond the label to the substance underneath.
That's a perfect way to frame it.
We start with Section 2 of the Act, which just says dividend is a form of income. Simple enough.
Right. Then Section 222 steps in with this comprehensive, inclusive definition. It's not just everyday cash dividends. It covers very specific distributions or payments that are legally deemed to be dividends.
Even if the company doesn't call them that.
Precisely. And once something gets classified as a dividend under this broad definition, Section 562 makes it absolutely clear. It's fully chargeable under income from other sources.
No ambiguity there.
So let's peel back the layers and break down these different categories of deemed dividends because they seem crucial for understanding corporate distributions and potential tax traps.
Absolutely. And the inclusive nature of Section 222 is an incredibly powerful anti-avoidance tool. The legislature clearly foresaw various, let's say, ingenious methods companies might use to distribute profits or assets to shareholders without formally calling them dividends, trying to escape tax. This section basically closes those loopholes, making sure that various forms of value extraction from a company are brought into the tax net. Hashtag 2.1, the broad definition of dividend.
Let's start with the first one. Section 222, asset distribution. What exactly does this clause cover? Is it just cash?
Well, this is perhaps the most straightforward of the deemed dividend provisions. It refers to any distribution of accumulated profits, and here's the key phrase again, whether those profits have been capitalized or not,
Right.
by a company to its shareholders, which involves the actual release of any or all of the company's assets. So yes, a simple cash dividend is the obvious example.
But it could be other assets too.
Definitely.
Yeah.
If the distribution is in kind, for instance, if a company gives its shareholders shares of another company it owns, or maybe even property, the market value of those assets on the distribution date would be deemed as dividend in the shareholders' hands. The core idea is if assets representing accumulated profits move out to shareholders, it's treated as a dividend.
So not just cash, anything of value the company holds and distributes. Okay, what about Section 2 debentures, deposit certificates, and even bonus shares to preference shareholders? This sounds like another way to shift value.
Indeed. This clause further broadens the scope. It covers any distribution by a company to its shareholders of debentures, debenture stock, or deposit certificates. Doesn't matter if they carry interest or not.
Okay.
And crucially, any distribution of bonus shares, specifically to preference shareholders, also gets deemed as dividend. Again, this only applies to the extent the company actually possesses accumulated profits, whether capitalized or not.
How are these valued?
For the bonus shares to preference shareholders, it's their market value. For debentures or deposit certificates, it's their market rate. Or if there isn't one, you use accepted valuation principles.
Now, you emphasized preference shareholders for bonus shares. What about equity shareholders?
That's a critical distinction and a very common point of confusion or, let's say, a potential exam trick.
Yeah.
Bonus shares given to equity shareholders are explicitly not treated as dividend under this section. Vital distinction.
That is a key distinction. Equity shareholders getting bonus shares, not taxed as dividends. Yeah. Now, what about when a company's winding down? Section 222C deals with distributions during company liquidation.
Right. On liquidation, any distribution made to shareholders is deemed a dividend, but there's a limit. It's only to the extent that it's attributable to the accumulated profits the company had immediately before its liquidation.
Whether capitalized or not.
Yes, that phrase applies here too. It's important to distinguish this from distributions made from profits that might arise after the date of liquidation. Those aren't deemed dividends. They're considered more like a repayment towards the shareholder's capital. The law wants to tax those accumulated profits even if released during winding up.
And a similar idea seems to apply when a company reduces its capital under Section 222.
Precisely. Any distribution to shareholders by a company when it reduces its capital is also deemed a dividend. Again, to the extent the company possessed accumulated profits. But here there's a specific historical date. Only profits that arose after March 31st, 1933.
Interesting cutoff.
Yes, it ensures very old, pre-independence profits aren't caught. But the core principle is the same. If capital reduction is basically a disguised way of distributing accumulated profits, it gets taxed as a dividend.
This phrase, whether capitalized or not, keeps appearing across these clauses. What's the real significance? Why is the law so insistent on it?
Ah, that phrase, whether capitalized or not. It's a statutory directive with a very specific, very powerful anti-avoidance purpose. It ensures that the taxability of a distribution is governed by its ultimate origin. Did it come from accumulated profits? Even if those profits were later, converted into share capital through a bonus issue or some other accounting entry.
So it looks past the accounting label.
Exactly. It looks past labels like share capital to the underlying economic substance, which is it came from profits. Without this phrase, companies could, for instance, capitalize profits into bonus shares, then later reduce that capital and argue it's just a return of capital, not a distribution of profits.
Okay.
It would allow them to potentially escape dividend tax. The law deliberately blocks that sophisticated loophole by saying, we look at the source, not the temporary accounting classification.
Now, this next one, Section 222E, feels like a really major anti-avoidance rule, specifically targeting private companies or closely held companies, loans and advances. This seems like where companies might often try to give benefits to major shareholders without calling it a dividend. This feels like a big one for application questions.
Absolutely. This provision, 222, is designed to tackle a very common tax planning strategy often seen in closely held businesses. If a company where the public are not substantially interested, basically, a private company where ownership is concentrated.
Like a family business or a small group.
Right. If such a company gives an advance or a loan to certain specified individuals or entities, that sum can be legally deemed a dividend. The legislature clearly saw loans to dominant shareholders as a convenient way to pull profits out tax-free. This section shuts that down.
So what are the exact conditions? Who is the target? It's not just any shareholder getting a loan, is it?
No, you're right. It's quite specific. There are three main types of recipients that trigger this. First, the recipient has to be a shareholder who is the beneficial owner of 10% or more of the company's voting power. So substantial shareholders.
10% or more.
Second, it can also apply if the payment goes to any concern.
Yeah.
Concern is defined broadly. It includes an HUF, a firm, an AOP, a BOI, or even another company in which such a substantial shareholder, the one with 10% or more voting power, is a member or partner and also has a substantial interest himself within that concern.
So it follows the money through related entities.
Exactly. And thirdly, any payments made by such a closely held company on behalf of or for the individual benefit of any such substantial shareholder are also covered.
Like paying their personal bills.
Could be, yes. In all these situations, the amount deemed as dividend is strictly capped. It's limited to the extent of the company's accumulated profits. You can't deem more dividend than the profits available.
That's a lot of definitions to keep straight. How do we understand accumulated profits specifically for this clause? And what about substantial interest and concern? This seemed critical.
Okay, let's clarify those. For clauses 222, A, B, and this one, E. So asset distributions, debentures preference, bonus shares, capital reduction, and loans advances accumulated profits generally include all profits up to the date of distribution or payment, whether capitalized or not.
Okay.
For 222, liquidation, it's profits up to the date of liquidation. There is an important exclusion based on case law, like CIT v. Jaldu Ramarao, for amounts set aside specifically for building and machinery depreciation funds. Also, on amalgamation, the accumulated profits of the merging company are included in the resulting company's accumulated profits.
Right. And substantial interest and concern.
Okay. For a concern that isn't a company, like a firm or HUF, substantial interest means the person is entitled to at least 20% of the income of that concern.
20%.
If the concern is a company, substantial interest means holding 20% or more of the voting power in that company. And concern itself, as I mentioned, is defined broadly. HUF, firm, AOP, BOI, or a company. These definitions work together to map out the web of connections this anti-avoidance rule is trying to capture.
It seems very broad. Are there any crucial exceptions to the two? It sounds like almost any loan from a private company could get caught otherwise.
It is broad, but yes, there are two very important exceptions that significantly temper its application. First, if the loan or advance is granted in the ordinary course of the company's business. And crucially, if lending money is a substantial part of that company's business.
Like a private finance company or a bank.
Exactly. Think of a private limited company that operates mainly as a financial institution. Its core business is lending. To figure out substantial part, you'd look at things like the percentage of turnover from lending, proportion of profit, manpower, capital employed in lending compared to the whole business. The CIT v. Parle Plastics Ltd. case gives some guidance there.
Okay, that makes sense. And the second exception?
The second is about dividends set off. If a loan was already treated as a deemed dividend in 1 year, but later the company formally declares a real dividend to that same shareholder, and that dividend is then used to set off or repay the earlier loan.
You don't tax it twice.
Correct. The adjusted amount is not treated as dividend again. It prevents double taxation of the same economic benefit flowing to the shareholder.
So if I borrow money from my closely held company, it gets deemed a dividend. But what if I repay it later? Does that undo the tax? Or what if the company starts charging me interest? Does that change the original deeming?
Crucially, no. And this is a point that often trips people up. Subsequent repayment of the loan, or the company starting to charge market rate interest after the loan was given. Neither of these actions affects the initial applicability of Section 222.
Really?
Yes. The moment the loan or advance is made under the specified conditions, the deeming fiction applies. The tax event occurs in that previous year. Subsequent actions, while maybe commercially relevant, don't retroactively undo the tax consequence that already happened.
Wow. Okay. That's important. Now, this has raised a big practical question. What about trade advances? I've seen some interesting case law, and didn't the CBDT issue a circular on this? Seems like a common area of dispute.
Indeed, a very practical and frequently tested area. The underlying principle here is clear. Trade advances, which are fundamentally in the nature of commercial transactions, not gratuitous benefits, generally do not fall within the meaning of advance in Section 222.
So they're not deemed dividends.
Correct. They are typically not treated as deemed dividends. This distinction is vital for legitimate business operations. Let me give you a couple of examples from case law. In CIT versus Creative Dyeing and Printing PVT Ltd, advances made by a company to a sister concern were later adjusted against bills for job work. The court held these weren't deemed dividends because they were for business purposes.
Makes sense.
Similarly, in CIT versus Amrit Singh, an advance given to a shareholder to install machinery specifically for job work to fulfill an export order, not a deemed dividend. Clear business expediency.
Right.
And in CIT, Agra versus Atul Engineering Udyog, a security deposit taken from a director against electricity generators was seen as a normal business transaction, not a gratuitous loan. The CBDT's Circular No. 19/2017 basically formalizes this judicial position, confirming that genuine trade advances in the ordinary course of business are out.
So the takeaway is?
The takeaway is the tax law looks beyond the label. If it smells like profits being distributed in disguise, it's taxed as a dividend. But if it's a genuine business transaction with a commercial reason, even if it involves a shareholder, it generally won't be caught by 222.
Okay, let's apply this. Consider Double, MDME, holds 65% of R of PLTD. He gets an advance in the company, but it's specifically for executing job work, deemed dividend or not.
In Double's case, even though he's a substantial shareholder, the key is the purpose. Execution of job work. That signals a commercial transaction. So consistent with cases like CITV Rajkumar and CITV Ambassador Travels and the CBDT Circular, this advance is not a deemed dividend under 222. It's business related.
All right. And Mr. Santhanam, he holds 25% in VKS Manufacturing PVT Ltd. The company gives him 10 lakh advance, but it's in return for him not releasing his mortgage land, which helped the company's loan security. Big complex.
This is a great nuanced example. Mr. Santhanam's advance is directly linked to a tangible benefit for the company keeping his land mortgaged help their loan. As held in Pradeep Kumar Malhotra CIT, if a loan or advance is given in return for a clear advantage conferred on the company by the shareholder, it's not seen as gratuitous.
So there's a quid pro quo.
Exactly. A commercial rationale exists, therefore it does not fall under Section 222. The assessing officer arguing it's a deemed dividend wouldn't be correct here.
So that the purpose is key. Genuine business need versus just funneling money. But what if it's indirect? Like Parimal, MD, 70% shares. He gets 5 lakhs from his supervisor who got it from the company's general reserve, 6 lakhs available. Does the supervisor shield him?
No, the intermediary doesn't change the substance. In Parimal's scenario, the supervisor is just a conduit. The funds originate from the company's accumulated profits, the general reserve, and are clearly for Parimal's individual benefit given his substantial holding. The Supreme Court was very clear in L. Alexandaram Chettiar v. CIT. Such indirect payments are treated as deemed dividends under 222. The law looks through the structure.
Right, looks through. Okay. Moving on to another big area, Share buybacks and dividend taxation, covered partly under Section 222. There's been a crucial, pretty recent change here, hasn't there,
Yeah.
affecting domestic companies?
Absolutely. The tax treatment of buybacks by domestic companies underwent a fundamental shift, which is vital for shareholders to understand. Before October 1st, 2024, the primary tax burden was on the company itself.
How did that work?
An additional income tax, often called buyback tax or DDT on buybacks, was levied on the company under Section 115QA. It was around 20% plus surcharge and cess. Consequently, the income the shareholder received from the buyback was explicitly exempt in their hands under Section 1034A.
Okay, so company paid, shareholder didn't. But that changed.
Dramatically. On or after October 1st, 2024, any sum paid by a domestic company to buy back its own shares is now deemed as a dividend directly in the hands of the shareholders.
So the tax shifted to the shareholder.
Yes, this income is now taxable at their applicable individual tax rates. And a really critical point for application questions. No deduction for any expenses is allowed against this deemed dividend income. It's taxed on the gross amount received.
Let's use an example to make that really concrete. Say, Mr. B has 100 shares of A Ltd. Bought at 40 each. A Ltd. Buys back 20 of those shares at 60 each in, say, November 2024. What are the full tax implications for Mr. B? This feels like a perfect exam question setup.
Excellent scenario. Let's break it down for Mr. B. First, the deemed dividend. For the 20 shares bought back, the amount he received is $1,200. 20 shares, 60 share. This entire $1,200 is taxable as deemed dividend under Section 222. It gets added to his total income and taxed at his normal slab rates.
Okay, so tax on the 1,200. But what about the capital gain or loss aspect? He originally paid 40.
Right. Simultaneously, this buyback also triggers a capital loss for Mr. B under Section 46A. For capital gains purposes in a buyback scenario like this, the consideration is deemed to be nil.
Nil consideration. Okay.
Yep. So the capital loss is calculated as nil consideration minus the cost of acquisition. His cost was 40 per share for 20 shares, so 800 cost. The capital loss is therefore 800.
And what can he do with that 800 capital loss?
He can set it off against other capital gains he might have in the same year. Or if he doesn't have enough gains, he can carry it forward to future years to offset future capital gains. If Mr. B later sells his remaining 80 shares, any gain on that sale could be reduced by this carried forward loss. It shows how one transaction hits both IFOs, dividend, and capital gains loss.
That's a fantastic illustration of the interplay. Now, besides these specific deemed dividend clauses, are there any general exclusions from what counts as a dividend that we should keep in mind?
Yes, there are a few general exclusions that complement the specific loan exceptions under 220. For instance, distributions made on non-participating shares during liquidation or capital reduction, especially if they were issued for full cash consideration, are often excluded. Also, payments made on buyback of shares up to September 30, 2024 were specifically excluded, as that was under the old regime.
Right.
And very importantly for corporate restructuring, the distribution of shares by the resulting company to the shareholders of the demerged company during a demerger is explicitly not treated as a dividend. This facilitates reorganizations without immediate tax hits for shareholders.
So looking at all of this, the intricate definition of dividend, it really ensures that various ways companies distribute value, direct cash, indirect benefits, buybacks now are all brought into the tax net, right? It's fundamentally about stopping tax avoidance on profit distributions.
Precisely. It's designed to prevent tax avoidance by stopping people from restructuring payments that are, in essence, distributions of accumulated profits.
And how is the timing handled? When does the tax clock actually start ticking for the shareholder on these dividends?
The basis of charge is governed by Section 8, and it's pretty clear. A dividend, whether it's formally declared, actually distributed, or paid, is deemed to be the income of the shareholder in the previous year in which it's actually declared, distributed, or paid.
So basically on receipt or when it becomes available?
Yes, essentially on a receipt or availability basis. For interim dividends specifically, they're deemed income in the previous year when they are unconditionally made available to the members entitled to them.
And the tax rate.
Any income by way of dividend received by a resident from a company, whether domestic or foreign, is fully taxable in the hands of the shareholder at their normal applicable tax rates. It just gets added to their other income and taxed according to their slab.
Okay, let's shift gears slightly. Ever wonder if issuing shares at a big premium could be, maybe, a way to channel unaccounted money into a company, a potential loophole? Well, the law seems to have a sharp eye on that too, especially for closely held companies. Section 566(2) targets this specifically.
That's exactly right. This provision is a powerful anti-avoidance measure. It's particularly designed to curb the practice of, let's say, converting black money or unaccounted funds into white money by artificially inflating the value of shares when they're issued.
How does it work then?
Here's the mechanism. If a closely held company issues its shares at a premium, meaning the issue price is higher than the share's face value, and, critically, if that issue price also exceeds the fair market value, FMV, of those shares, then the excess amount gets taxed.
Ah, so it's not just about issuing above face value, it's about exceeding the fair market value. That's the key comparison.
Precisely. The amount that becomes taxable is the difference between the issue price and the fair market value. And importantly, this is taxable as income under IFRS, but in the hands of the company itself, the one issuing the share.
In the company's hands, not the shareholder buying them.
Correct. The tax liability falls on the company receiving the excessive premium. Let's use an example. Suppose a share has a face value of 10. Its objectively assessed fair market value, FMV, is 100, but the company issues it at 145.
Okay, so definitely issued at a premium over face value.
Yes, 135 premium over face value. But the taxable amount isn't that 135. We compare the issue price, 145, to the FMV 100. The excess is 45, 145, 100. This 45 per share is taxed as income under IFOS in the hands of the company.
So the law is trying to stop companies from generating huge untaxed premiums way above what the shares are actually worth.
Exactly. It ensures the transaction reflects genuine economic value, preventing inflated premiums from being used to potentially launder funds.
Now we move to a section that catches many people off guard and is, I imagine, a frequent area for exam questions. Gifts and properties, specifically Section 562X. The core idea seems to be about taxing value received without paying enough for it, right? Preventing tax avoidance through things that look like gifts.
You've absolutely nailed the central objective. This section was brought in specifically to stop the widespread practice of transferring money or property either for free or for way less than it's worth, purely to avoid tax. It makes sure such receipts are brought into the tax net and are taxable in the hands of the recipient. It's a very broad provision covering three main categories: sums of money, immovable property, and movable property.
Let's start with the simplest money. How does Section 562X treat, say, cash gifts? Is there a minimum amount, and what happens if you go over it?
For sums of money, the rule is quite straightforward. If you receive any sum of money without consideration, basically, as a gift, and the aggregate value of all such sums received during the entire financial year exceeds $50,000.
Aggregate value, okay.
Yeah. Yes, aggregate. If that total exceeds $50,000, then the whole of that aggregate value becomes chargeable to tax under IFOS.
Wait, the whole amount, not just the amount over $50,000.
Correct. That's a common misconception. For example, if you receive $75,000 in cash gifts throughout the year, the entire $75,000 is taxable, not just the $25,000 excess over the $50,000 threshold. It's an all-or-nothing rule once you cross that aggregate $50,000 limit for cash. Crucial point. Hashtag tag 4.2 specifics for different property types.
That whole amount detail is absolutely critical. Okay, what about immovable property? Land or buildings? This is where it gets a bit more complex, I believe, with stamp duty values coming into play.
Indeed. Immovable property for this section means land or building or both. Now, there are two scenarios. First, if it's received without consideration as a pure gift and its stamp duty value, SDV, exceeds $50,000, then the whole SDV is taxed as income for the recipient.
Similar to cash, but based on SDV.
Exactly. The second scenario is when it's received for inadequate consideration, meaning you paid something, but it was less than the SDV. In this case, you look at the difference between the SDV and the consideration you paid. If that difference is more than the higher of two amounts, $50,000 or 10% of the actual consideration you pay.
Higher of $50K or 10% of consideration.
Okay.
If the difference exceeds that higher benchmark, then the entire difference is taxable in the hands of the recipient as IFOS.
Let's put that into a concrete example. Say a property has a 25 lakh SDV, but I managed to buy it for 20 lakh. How would that play out for me, the buyer, under this section?
Great question. Let's walk through it.
Right.
First, calculate the difference. 25 lakh SDV minus 20 lakh consideration equals 5 lakh.
Okay, 5 lakh difference.
Next, we compare this 5 lakh difference to the higher of two benchmarks. 50,000 or 10% of the consideration paid. 20 lakh, 10%, just 2 lakh.
The higher benchmark is 2 lakh.
Correct. Now, is the actual difference 5 lakh greater than the benchmark 2 lakh? Yes, it is.
Much greater. Therefore, the entire 5 lakh difference is taxable in your hands as income from other sources. It's also really important to remember that this 50,000 10% test is applied per property. It's not aggregated for immovable properties. Each transaction stands on its own.
Per property. Okay.
Hmm.
That breakdown makes it much clearer. And what about the timing for that stamp duty value? If there's a gap between when I sign the agreement and when I actually register the property, which SDV do I use, that could make a huge difference, especially if prices are rising.
This is a frequently tested point, precisely because of its practical impact. The law provides some flexibility here. To account for time gaps, you can use the stamp duty value as on the date of agreement, instead of the potentially higher SDV on the date of registration.
That sounds helpful. Is there a catch?
Yes, there's a crucial condition. This flexibility is only available if the whole or part of the consideration was paid using a specific verifiable electronic mode. This includes an account pay check, an account pay bank draft, ECS, or other prescribed electronic modes like credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, or BHI Aadhaar Pay.
So traceable payment methods.
Exactly. And that payment must have happened on or before the date of the agreement. If you paid by just a cross check, which is an account pay, or if the payment happens after the agreement date, then you lose this benefit and you have to use the SDV on the date of registration.
That if I disagree with the SDV.
If the assessee disputes the SDV, the assessing officer has the power to refer the valuation to a valuation officer. And the rules similar to Section 50C, which deals with capital gains on property sales, would apply to determine the value.
Got it. Okay, moving to movable property, basically anything other than immovable property. How are these treated under Section 562X? Is it aggregate value again, like with cash?
For movable property, yes, it's back to aggregate value.
If received without consideration, as a gift, and the aggregate fair market value, FMV, of all such movable property received during the year exceeds $50,000, then the whole aggregate FMV is taxed as income of the recipient.
Whole amount again if over 50K aggregate.
Correct. Second scenario, if received for inadequate consideration. Here, you look at the difference between the aggregate FMV of the properties and the total consideration paid. If that difference exceeds $50,000, then that entire difference is taxed as income.
So, similar to cash, movable property uses the aggregate test for the 50,000 threshold. If I get 5 paintings, each worth 15,000, that's 75,000 total.
Then the whole 75,000 aggregate FMV would be taxable, assuming paintings fall under the definition of property for this section.
Yeah.
Hashtag 4.3, what counts as property for gift taxation.
Right, and that brings us to a super important point for exams, I suspect, because not everything counts as property under this specific section, does it? It's actually a very limited list. What precisely qualifies?
That is a highly critical point, often a trap. Property is not a generic term here. It's very specifically defined for Section 562 as a capital asset of the SSE.
Capital asset, okay.
Which immediately means it excludes items held as stock in trade, raw materials, or consumable stores for a business. The law then provides an exhaustive list of the types of capital assets that count as property here. 1. Immovable property, land or building or both. 2. Shares and securities. 3. Jewelry. 4. Archaeological collections. 5. Drawings. 6. Paintings. 7. Sculptures. 8. Any work of art. 9. Bullion. 10. And significantly, virtual digital assets. Think cryptocurrencies were added recently.
So what's not on their list? What doesn't count as property here, even if it's valuable?
Crucially, items like cars are not on the list, or agricultural land if it doesn't meet the definition of a capital asset in that specific context, e.g. rural agricultural land. This narrow definition creates some important practical exemptions.
So to be absolutely crystal clear, if someone gives me a car, even a really expensive one, it's generally not taxable under this Section 562X. That feels a bit counterintuitive.
That's absolutely correct. Because cars are not explicitly listed in the definition of property for this section, a gift of a car simply doesn't trigger this provision, regardless of its value exceeding $50,000. The law is very specific about the types of assets it's targeting with this anti-avoidance measure.
Let's talk about the important exceptions now, situations where gifts are not taxable, even if they involve money or listed property types. This is where the definition of a relative becomes absolutely key, and it's a surprisingly broad definition for individuals, isn't it?
It is indeed, and understanding who qualifies as a relative is vital for applying the exemptions correctly. For an individual recipient, relative includes a very wide circle: their spouse, their brother or sister, their spouse's brother or sister, so brother-in-law, sister-in-law, the brother or sister of either their parents, aunts and uncles, any lineal ascendant, parents, grandparents, or descendant children, grandchildren of the individual, any lineal ascendant or descendant of their spouse, spouse's parents, grandparents, children from a previous marriage, etc. And finally, the spouse of any of the people mentioned above, G, sister's husband, aunt's husband.
Wow, that covers a lot of family connections.
It does. However, for a Hindu undivided family, HUF, receiving a gift, the definition is much, much narrower. For an HUF, only any member thereof counts as a relative.
Only a member of the HUF.
Yes. This distinction between the individual definition and the HUF definition is paramount in practice.
So let's take a practical application. If Akhil HUF receives 75,000 cash from Akhil's niece, who is the daughter of Akhil's sister, is that taxable for the HUF?
Yes, that $75,000 would be taxable in the hands of the Akhil HUF.
Why? She's his niece, surely a relative.
She is a relative to Akhil as an individual under that broad definition we just discussed. But she is not a member of Akhil HUF. Since she's not a member, she doesn't fit the narrow definition of relative for the HUF. Therefore, the cash gift exceeds $50,000 and comes from a non-relative to the HUF, making it fully taxable for the HUF. It perfectly highlights why the recipient entity, individual versus HUF, matters so much for the relative definition.
That's a critical distinction. What if Natisha, who is a member of an HUF, transfers her house property to the HUF without any payment? Taxable.
In that specific case, it would be non-taxable under Section 5062X. Why? Because Natisha is a member of the HUF, she qualifies as a relative to the HUF. Gifts or transfers without consideration between relatives are exempt. However, it's worth just adding a small note here. While the receipt isn't taxed under 562X, any income generated from that property later might potentially get clubbed back into Natisha's hands under Section 64 to prevent income diversion, but that's a separate clubbing provision issue. The initial receipt by the HUF is exempt under 562X.
Right. Beyond relatives, what are the other major exceptions where gifts or property received without adequate consideration are not taxable under 562X? There seem to be quite a few important ones.
Yes, the law carves out several other critical circumstances. Sums of money or property received are explicitly excluded if they are received. On the occasion of the marriage of the individual recipient, this is specifically for the bride or groom, gifts received by guests generally aren't covered by this unless they fall under other exemptions, under a will or by way of inheritance. So inherited assets escape this section. In contemplation of the death of the payer or donor, these are gifts made shortly before death, treated similarly to inheritance, from any local authority, from specific approved funds, foundations, universities, hospitals, charitable trusts, etc., those registered under Section 12A2A, A12, AB, or notified under 1023C.
But there's a catch there, right? About specified persons.
Yes, good point. That relaxation for charitable institutions doesn't apply if the recipient is one of the specified persons mentioned in Section 13.3, which basically targets situations where the institution might be improperly benefiting related parties or founders.
Okay, any others?
Also exempt are receipts from transactions, not regarded as a transfer, under various clauses of Section 47. These cover specific corporate or family reorganizations. And finally, receipts from an individual by a trust created solely for the benefit of that individual's relative. This allows for certain family trust distributions.
And just briefly, for context, there were those temporary COVID-19 related exemptions too, right? For medical treatment and payments to families of deceased.
Yes, exactly. While likely not relevant for current exams, it's good to know they existed. Payments for COVID medical treatment with conditions like positive reports, forms, and payments to families of those who died from COVID, from employer without limit, from others up to 10 lakhs, again with conditions like death certificates, forms, were temporarily exempted under this section as relief measures.
And there are also some very specific, maybe less common exemptions under Rule 11 UAC for particular transactions. What are some examples there?
Yes. Rule 11 UAC provides targeted relief for certain specific, often complex situations, usually driven by government policy or major restructurings. Some key examples include receipts related to immovable property in Delhi's unauthorized colonies, if they get regularized by government notification. Receipts of unquoted shares of a company and its subsidiary, if received under an NCLT-approved resolution plan after the board was suspended, think situations like Jet Airways. Equity shares of a reconstructed bank, like the shares allotted at 10 during the Yes Bank reconstruction. Equity shares received under strategic disinvestment of a public sector company. Certain receipts of shares units by fund managers due to fund relocation under specific conditions. These are generally designed to facilitate specific economic goals or restructurings without triggering unintended gift tax consequences.
Let's try and cement this understanding with some practical scenarios. What about that Dr. Ranjan Pai v. PCIT case regarding bonus shares issued to equity shareholders? How does that fit with Section 562?
The Dr. Ranjan Pai case is a very significant clarification. It firmly established that bonus shares received by equity shareholders are not taxable as gifts under Section 562X.
And the reasoning?
The core rationale is crucial. Issuing bonus shares is merely a reallocation or capitalization of the company's existing funds or reserves into share capital. No new value is actually flowing to the shareholder from outside. Instead, the value of their original shares effectively decreases proportionally when the bonus shares are issued.
So it's just slicing the pie differently.
Exactly. It's a financial rearrangement within the company and the shareholder's existing investment pool, rather than a fresh receipt of value. Therefore, it's not considered a taxable gift under this provision.
That's very clear. Now let's take a comprehensive look at Mr. A. He's a share dealer. He receives various items during the year. Cash gift, some bullion, some shares of XLTD, a gifted plot of land, and a building bought for what seems like inadequate consideration. Let's walk through the tax implications for each of these for Mr. A. This feels like a classic multi-part exam question.
Okay, excellent. Let's break down each of Mr. A's receipts systematically. 1. Cash gift. He received $75,000 in cash. Since this aggregate sum exceeds the $50,000 threshold for money received without consideration, the entire $75,000 is taxable under Section 56(2)(x) in Mr. A's hands.
Full $75K. Got it.
2. Bullion. He receives bullion with a fair market value, FMV, of $60,000. Bullion is specifically listed as property under 56(2)(x). Since its FMV, $60,000, exceeds $50,000, the entire $60,000 is taxable as IFOS for Mr. A.
Okay, $60K tax too.
3 XLTD shares. Mr. A receives 1,000 shares of XLTD from another dealer. He bought them at $400 when their FMV was $600. Now, the absolute key here is that Mr. A is a share dealer.
Ah, so there's his stock and trade.
Precisely. These shares represent his stock and trade, not a capital asset. Since Section 562X only applies to property defined as a capital asset, these shares received by him as stock and trade are not taxable under this section, even though he got them below FMV. Any profit or loss when he eventually sells them will be his business income or loss.
Crucial distinction based on his business.
Okay. 4. Plot of land. Gifted. Mr. A receives a plot of land in Faridabad as a gift. Its stamp duty value, SDV, is $5,000. This is immovable property received without consideration. Its SDV, $5,000, clearly exceeds the $50,000 threshold. Therefore, the entire $5,000 SDV is taxable as IFOs in Mr. A's hands.
Full SDV taxed. Yep.
Right. Property, building for inadequate consideration. Mr. A booked a building 2 years ago for $20 lakh. The SDV on the booking date was $23 lakh. On the possession registration date, it's $32 lakh. He paid $1 lakh by an account paycheck on the booking date. What SDV do we use?
Since he paid by a paycheck before the agreement date, he can use the lower SDV on the booking date, so 23 lakh.
Exactly right. Because part payment was made by a prescribed mode on or before the agreement date, we use the SDV on the agreement booking date, which is 23 lakh. Now, let's calculate the taxable amount. The difference between SDV 23 lakh and commensuration 20 lakh is 3 lakh.
Okay.
Next, we compare this 3 lakh difference to the higher of 50,000 or 10% of the consideration. 20 lakh, 10% is 2 lakh. The higher benchmark is 2 lakh.
And the difference, 3 lakh, is greater than the benchmark, 2 lakh.
Correct. Since 3 lakh is greater than 2 lakh, the entire 3 lakh difference is taxable under IFOS in Mr. A's hands.
So 3 lakh tax there.
6. Capital gains on sale of gifted land. Now later, Mr. A sells that gifted Faridabad plot, which was taxed at 5 lakh SDV under 56(2)(x) for 7 lakh. How do we calculate the capital gain? What's the cost?
Ah, okay. Since it was taxed as a gift earlier, does the amount taxed become his cost? So 5 lakh cost.
Precisely. Section 49(4) says that if an asset's value is taxed under Section 56(2) upon receipt, that taxed value becomes the cost of acquisition for the recipient. So his cost is 5 lakh.
Okay. Sale price 7 lakh, cost 5 lakh, that's a 2 lakh gain, short term or long term. Does he get the previous owner's holding period?
Good question. For assets taxed under 56(2)(x), the holding period starts from the date the recipient acquired it. You do not get the benefit of the previous owner's holding period in this specific situation. So assuming Mr. A sells it relatively quickly, this 2 lakh gain, 7 lakh, 5 lakh would be a short-term capital gain.
That's an incredibly comprehensive breakdown, showing how 56(2)(x) interacts with business income, capital assets, and even later capital gains calculations. Fantastic. Let's look at another complex scenario. Mr. Hari is a property dealer. Mr. Rajesh deals in automobile spare parts. Hari sells a building to Rajesh for 90 lakh. The SDV is 150 lakh on the transfer date, but it was 140 lakh on the agreement date. Hari received a 15 lakh down payment on the agreement date, but by cross-check. Walk us through the tax implications for both Hari and Rajesh, and then how would it change if Hari was, say, a share broker instead?
This scenario is a perfect illustration of how the seller's business, the buyer's status, and the specific mode of payment dramatically alter tax outcomes, triggering different sections. Let's break it down.
Mr. Hari is a property dealer. In Mr. Hari's hands, the seller. Since Hari is a property dealer, the building is his stock in trade. Section 43CA applies here, which deals with sales of stock in trade for less than SDV. The consideration is 90 lakh, SDV is 150 lakh, transfer 140 lakh agreement. Crucially, the down payment was by cross-check, not account pay or electronic.
So he can't use the lower agreement date SDV.
Correct. He has to use the SDV on the transfer date, which is 150 lakh. Since 150 lakh exceeds 110% of the 90 lakh consideration, Section 43CA is triggered. His deemed sale consideration for business income calculation is 150 lakh. If his original purchase price was, say, 75 lakh, his business income would be 75 lakh. 150 lakh, 75 lakh.
Okay, 75 lakh business income for Hari. What about Rajesh, the buyer?
In Mr. Rajesh's hands, the buyer. For Rajesh, the spare parts dealer, this building is likely a capital asset, unless he bought it specifically for his business premises, which might have other implications, but let's assume it's a capital asset for investment or personal use. So Section 56(2)(x) applies to him. He paid 90 lakh for a property with an SDV of 150 lakh. Again, transfer date SDV applies due to the cross-check. The difference is 60 lakh, 150 lakh, 90 lakh.
Compare that to the benchmark.
Right. Compare 60 lakh to the higher of 50,000 or 10% of consideration. 90 lakh, 10% is 9 lakh. The benchmark is 9 lakh.
And 60 lakh is way higher than 9 lakh.
Exactly. Therefore, the entire 60 lakh difference is taxable under income from other sources in Mr. Rajesh's hands.
Mr. Hari as a share broker instead of property dealer. In Mr. Hari's hands, the seller. Now, if Hari is a share broker, that building is presumably a capital asset for him, not stock in trade. So Section 50C applies to the seller, which deals with capital gains on sale of capital assets for less than SDV. The logic is similar to 43CA regarding the SDV. Because the down payment was by cross-check, he must use the transfer date SDV of 150 lakh as his full value of consideration for calculating capital gains. So if his cost was 75 lakh, he would have a 75 lakh capital gain. 150 lakh, 75 lakh, likely short-term, assuming recent purchase.
So for Hari, it shifts from business income to capital gains, but the amount, 75 lakh, might be the same, just under a different head. What about Rajesh? Does Hari changing his business affect Rajesh?
In Mr. Rajesh's hands, the buyer. Absolutely no difference from Mr. Rajesh. The taxability under Section 562 depends on his circumstances receiving a capital asset for inadequate consideration. Hari's business is irrelevant to Rajesh's tax position here. The 60 lakh difference remains fully taxable under IFOs for Rajesh. This shows the asymmetric application of the seller's tax section depends on whether it's stock or capital asset, but the buyer's 506 liability is independent of the seller's business.
That perfectly illustrates the nuances. Okay, final examples for the section. Mr. Pervez receives a Maruti car as a gift from a distributor of his pharma company. No employment relationship. Taxable. And Kishan, HUF, gifts a car to the son of the Carta. Taxable.
For Mr. Pervez, the key is a car property under the Section 562X definition.
We established earlier, no, it's not on the list.
Correct. Since a car is not on the specific list of assets defined as property for 562X, the gift is not taxable under this section. And since there's no employer-employee relationship, it can't be a perquisite under salaries either. So the car gift to Mr. Pervez is not taxable.
Okay. And for Kishan HUF, gifting a car to the Carta's son.
Same logic applies. A car is not property, as defined in 562X. Therefore, the gift is not taxable under this section, regardless of the relationship between the HUF and the son. The definition of property is the gatekeeper here.
All right, let's move on to life insurance policies. These usually come with tax benefits, but it feels like there are some pretty critical lines in the sand now, especially with recent changes. Let's dive into Section 1010D exemptions and when proceeds might actually become taxable, potentially under Section 562.
Indeed. The general rule found in Section 1010D is quite generous. Typically, any sum received under a life insurance policy, LIP, including any bonus paid on it, is exempt from tax. It's meant to encourage insurance.
But there are exceptions, bigger ones.
Very significant exceptions have been introduced over the years, particularly targeting high-value policies used more for investment than pure protection. Hashtag 5.1, the general rule, and key exceptions for exemption.
What about Keyman insurance policies first? I have a feeling those are always treated differently, never exempt.
You're absolutely right. Keyman insurance policies are a consistent and major exception. These are policies taken by, say, a company on the life of a key employee or director whose loss would really hurt the business.
Okay.
The proceeds from a Keyman insurance policy are never exempt under 10(10)(d). They're always taxable. Where they go taxed depends on who receives the money. Under PGBP if the company gets it, under salaries if the employee gets it, maybe the policy was assigned to them, or under IFO if someone else receives it. It's a clear anti-abuse rule.
Okay, so Keyman policies are always taxable. Now, for regular LIPs, when do the proceeds become taxable because the premiums are too high relative to the sum assured? There are different percentage rules based on when the policy was issued, right? That can get confusing.
Yes, these premium limits are crucial and have evolved over time. Let's break down the timeline. Policies issued before April 1st, 2003. Fully exempt. No pre-in conditions apply. They're grandfathered. Policies issued between April 1st, 2003 and March 31st, 2012. Not exempt if the premium paid in any year exceeds 20% of the sum assured.
20% for that period. Okay.
Yeah. Policies issued on or after April 1st, 2012, the general rule now, stricter. Not exempt if the premium paid in any year exceeds 10% of the sum assured.
10% now.
But there's a slight relaxation for policies issued on or after April 1st, 2013, specifically for persons with disabilities under Section 80U or certain diseases under Section 80DB. For them, the limit is 15%. Not exempt if premium exceeds 15% of sum assured.
10% generally, 15% for the specific health conditions, 20% for older policies. Got it. That's a lot of dates and percentages. But what about death benefits? If the insured person dies, are the proceeds always exempt, regardless of these premium percentages?
Yes, this is a very important universal exemption. Any sum received on the death of the insured person is always exempt under 10(d). This holds true whether it's a regular LIP or a linked insurance policy, and it applies irrespective of the annual premium paid relative to the sum assured.
Always exempt on death, except for Keyman policies, presumably.
Exactly. The only exception to the death benefit exemption is if it's a Keyman policy. Also, just for completeness, amounts received under Section 80DD3. That's when a policy taken for a disabled dependent matures because the dependent unfortunately passes away before the policyholder by. Those specific proceeds are also not exempt under 10(10).
Okay, let's turn to unit-linked insurance policies, ULIPs. These are those hybrid products, part investment, part insurance. There's a relatively new 2.5 lakh premium threshold that applies specifically to ULIPs issued after February 1st, 2021. Why was this brought in?
ULIPs, as you said, combine investment and insurance. Historically, their proceeds often enjoyed the 10(10)(d) exemption, even with very large premiums. The 2.5 lakh threshold was introduced primarily as an anti-avoidance measure. It targets high-net-worth individuals who are arguably using ULIPs more as tax-efficient investment vehicles rather than for insurance.
Pouring large sums in, getting tax-free returns.
Precisely. The government felt this skewed the purpose of the insurance exemption. So the rule for ULIPs issued on or after February 1st, 2021 is, if the amount of premium payable for any previous year during the ULIP's term exceeds $2,050,000, then the sum received from that ULIP is not exempt under 10(d).
And where is the income tax then? IFO.
Interestingly, no. Such high premium ULIPs, once they lose their 10(10)(d) exemption, are generally treated as capital assets. Any income or gain from them is typically taxed under the head capital gains, not IFOs, unless the law specifies otherwise for a particular type of receipt.
Capital gains. Okay, so if someone invests in multiple ULIPs after that Feb 2021 date, how does the 2.5 lakh limit work? Is it per policy or do you add them up?
It's an aggregated limit, which adds complexity. If a person holds more than one ULIP issued on or after February 2021, and the aggregate premium payable on all such ULIPs combined exceeds $2,050,000 for any previous year,
aggregate exceeds 2.5 lakh.
Then the exemption under 10(d) is available only for those ULIPs, and the taxpayer gets to choose which ones, whose aggregate premium payable does not exceed $2,050,000. All the other ULIPs in that group, the ones that push the total over 2.5 lakh, become taxable.
So you have to pick and choose which ones stay tax-free.
Yes, up to the 2.5 lakh aggregate premium limit. And importantly, the underlying 10% of sum assured condition must also still be met for any ULIP chosen for exemption. It forces a decision on which high-premium ULIPs lose their tax-free status.
The CBDT issued detailed guidelines, Circular None 2020-22, to help with these ULIP scenarios. Can you walk us through some common examples from that?
Certainly. Let's look at their Situation 1, where no maturity proceeds have been received from eligible ULIPs in prior years. One eligible ULIP. If the premium is exactly 2.5 lakh and the sum assured SA is 25 lakh, it's exempt within 2.5 lakh limit and meets 10% SA rule, example 1. But if the premium is 5 lakh, it's not exempt. Exceeds 2.5 lakh limit, example 2. More than one eligible ULIP. More than one eligible ULIP, ULIP A, 1L premium, plus ULIP B, 1.5 L premium. Aggregate is 2.5 last. Both can be exempt if they meet 10% SA example 3. More than one eligible ULIP, ULIP A, 1L, plus ULIP B, 1.5L, plus ULIP C, 3L. Aggregate is 5.5L over 2.5L. The taxpayer chooses. They could exempt A and B, total 2.5L. ULIP C would then not be exempt, example 4. More than one eligible ULIP. Even if you have an old pre-2021 ULIP, say ULIP X, that's exempt anyway. The new ULIPs A, B, C from above are still tested against their own 2.5 lot aggregate limit, so X remains exempt. For A, B, C, you could still choose A and B to be exempt, making C taxable, example 5. The circular also details situation 2, example 610, which gets more complex, dealing with how receiving proceeds from one exempt ULIP affects the calculation for remaining ULIPs in later years. The core idea is you track your 2.5 lakh aggregate exemption usage over time.
So those rules are specifically for ULIPs. What about traditional life insurance policies, the non-ULIPs issued more recently, say, after April 1st, 2023? There's a new 5 lakh premium threshold here too, right? Kind of mirroring the ULIP change.
Yes, a very similar anti-avoidance logic was applied to non-ULIPs, showing the government's consistent approach to high-premium policies. For LEPs, other than ULIPs, issued on or after April 1st, 2023, if the amount of premium payable for any previous year during the policy's term exceeds 5,000.
5 lakh this time.
Yes, 5 lakh. If it exceeds that, the sum received from that policy is not exempt under 10D. And just like ULIPs, if you have multiple such policies issued on or after April 1st, 2023, and their aggregate premium exceeds 5,000 in any year, you get to choose which policies to exempt, up to that 5 lakh aggregate limit. Again, provided they also meet the general 10% of sum assured condition.
And the CBDT also issued a circular for these, Circular Note 1/2023. Can you illustrate how that works with examples?
Absolutely. Again, let's look at situation 1, no prior receipts for these non-ULIPs. One eligible LAP, a policy issued post-April 2023 with 5L premium and 50L NSA is exempt, example 12. But if the premium was 6L, it's not exempt, example 13. An older policy, maybe issued pre-2023 with a 6L premium, would still be exempt because the 5L limit is in retrospective, example 11. More than one eligible LIP, more than one eligible LIP, LIPA 3L premium plus LIPB 2L premium, aggregate 5L. Both can be exempt, example 14. More than one eligible LIP, LIPA 4.5L plus LIPB 5.5L, aggregate 10L over 5L. You can choose to exempt LIP within 5L, but LIP becomes taxable, example 15. More than one eligible LIP, LIPA 1L plus B 3.5L plus C 6L, total 10.5L. You could exempt A and B, total 4.5L, which equals 5L. C would then be taxable, example 16. More than one eligible LIP. Similar to ULIPs, if you have older pre-April 2023 policies, LIPX, they don't count towards the 5L limit for the new policies, ABC above. The new ones are tested separately, example 17. And again, situation 2 in the circular, examples 18, 19, 20, explains the more complex scenarios involving prior receipts and how they impact the ongoing 5 lakh aggregate calculation.
So putting it all together, what if someone has both new ULIPs post-Feb 2021 and new traditional LIPs post-April 2023? Do these 2.5 lakh and 5 lakh limits somehow combine, or are they totally separate buckets?
That's a very practical question, and the CBDT clarified it. Example 21 in their guidelines shows they are separate. The ULIP rules, with their 2.5 lakh aggregate threshold, apply only to ULIPs issued post-Feb 2021. The non-ULIP rules, with their 5 lakh aggregate threshold, apply only to non-ULIPs issued post-April 2023.
So you analyze each category independently.
Exactly. You don't add the limits together. Each type of policy has its own distinct set of rules and aggregation thresholds.
Any final quick clarifications on these insurance rules? What about the GST component in the premium or pure term insurance policies?
Yes. 2 important points often missed. First, for those LIPs issued after April 1st, 2023, when you're checking the 5,000 premium limit, you calculate it excluding any goods and service tax GST component. Use the net premium.
Net premium.
Second, and very important, the 5,000 premium limit does not apply to term life insurance policies. These are the pure protection plans, where the sum assured is paid only if the insured dies during the term and nothing is paid if they survive.
So term plans are safe from this limit?
Yes. Term plans remain fully exempt under 1010D, irrespective of the premium amount, as long as they meet basic conditions. And crucially, the premium paid for a term plan is not counted when you're calculating the 5,000 aggregate limit for your other non-UI policies. This clearly carves out pure protection products. Hashtag 5 time 5.5, how to compute taxable LIP income.
Okay, last point on insurance. If a life insurance policy, a non-ULIP, not Keyman, does become taxable because it failed one of these premium tests, how do we actually compute the taxable income? Is it the full amount received, or do you get to deduct the premiums you paid?
Good question. If a regular LIP is not exempt under 1010D, the sum received is specifically made taxable under income from other sources by Section 526(2). The computation method is laid out in Rule 11 UACA, and it aims to tax only the profit element.
How does that work?
If it's the first time you receive money from the policy, like on maturity, the taxable income is passive. The sum received minus the aggregate premium paid during the entire term of the policy.
Okay, so receipts less premiums.
But with a key adjustment, any premiums you might have already claimed as a deduction elsewhere, like under Section 80C, cannot be deducted again here. You only deduct premiums that haven't already given you a tax benefit.
Makes sense. And if it's a later receipt, like an annuity payment?
If it's a subsequent receipt, the taxable income is here. The sum received minus the aggregate premium paid up until the date of that subsequent receipt. Again, excluding any premiums already claimed as a deduction or used to reduce taxable income in previous receipts from the same policy.
So, for example, if I get 3 lakh from a non-exempt policy and I paid 2 lakh in premiums over the years, none claimed under 80C.
Then 1 lakh, 3 lakh minus 2 lakh, would be taxable under IFOS in the year you receive the 3 lakh. It taxes the net gain.
Okay, let's broaden our view now beyond dividends, share premiums, gifts, and insurance. What else gets swept into this versatile other sources bucket? This section seems to cover a pretty diverse range of income types.
It truly is a catch-all. First up, let's talk about casual income, which falls under Section 562 IB. This is income from, unforeseen or accidental sources.
Like winnings?
Exactly. Winnings from lotteries, crossword puzzles, races, including horse races, card games, any other games really, gambling, betting, things like that.
And how are these taxed? Normal rates or something special? And can you deduct, say, the cost of the lottery ticket?
These casual incomes are always taxable under IFOS. They attract a special flat tax rate of 30% under Section 115BD. We'll touch on that rate section shortly. But the critical point, often a trap, is that you cannot deduct any expenditure or allowance incurred to earn this income.
None at all. Not even the ticket cost.
Nope. If you win 1 lakh in a lottery, the full 1 lakh is subject to that 30% tax, plus cess, etc. You can't deduct the 100 you spent on tickets. This applies even if the income might seem related to a business. For example, the Manju & Co. case showed that prize money on unsold lottery tickets held by a distributor was taxed under this special rule, not as business income.
Wow, strict rule. Okay. What about interest received on compensation, or maybe enhanced compensation, when property is compulsorily acquired? That sounds like it could get mixed up with capital gains.
It can be confusing. Section 562(8) makes it clear that such interest is deemed income in the year of receipt. This timing rule is reinforced by Section 145(b)(1) and applies regardless of your accounting method. It's taxable under IFS.
But is all interest treated the same?
No. There's a crucial distinction clarified by the Supreme Court in Movalia-Bakubai Balapai v. ITO. Interest received under Section 28 of the Land Acquisition Act, which is essentially interest on the enhanced value of the land itself, is generally treated as partaking the character of compensation and taxed under capital gains.
Okay, interest on the enhanced value is capital gains.
But interest received under Section 34 of the same act, which is specifically for delay in payment of the compensation, that interest is taxable under IFOS.
Interest for delay is IFOS. Got it. Any deductions?
Yes, specifically for the interest taxable under IFOS, the delay interest, you get a flat 50% deduction under Section 57(4). So if you receive 5 lakh as interest for delayed compensation, 2.5 lakh is deductible and only 2.5 lakh is taxed.
Half is deductible. Clear. Next, forfeited advances under Section 526(2). This happens when, say, a property deal falls through after an advance was paid. How has the treatment changed?
This saw a significant shift. Before April 1st, 2014, if you received an advance for selling a capital asset and the deal fell through, you just kept the advance, and it was reduced from the cost of acquisition whenever you eventually sold the asset.
So it affected future capital gains.
Right, but on or after April 1st, 2014, from assessment year 2015-16 onwards, the rule changed. Such forfeited advance is now directly chargeable to income tax under IFOS in the year you forfeit it.
Taxed immediately.
Yes, and Section 51 was amended alongside this to prevent double impact. If it's taxed under 526, It's not then reduced from the cost of acquisition later. It became a separate, immediate, taxable event.
Okay. What about compensation received for termination of employment or changes in job terms? That sounds like it should be under salaries.
Section 566(2) deals with this. Generally, such compensation or payment is chargeable under IFOS. However, there's a very important exception if the payment is received from your employer or former employer.
Ah, the source matters again.
Exactly. If it's from the employer, it's specifically covered under Section 1721 and taxed under the head salaries. If it comes from someone else, say a third party involved in the termination or modification, then IFOS applies.
Got it. Employer payment, salaries, otherwise IFOS. What about sums received from business trusts like REITs or invites? These are becoming more common investments.
Yes, Section 5612 specifically brings certain sums received by unit holders from business trusts, REITs, invites, into the IFOS net. The calculation's a bit technical, though.
How does it work?
You calculate a specified sum. It starts with the aggregate amount distributed by the trust, but you exclude amounts already taxed elsewhere or exempt, like interest dividend under 1023 SC or rental under 1023 SCA, or amounts not taxed in the trust's hands under a 115 UA2. From that net distribution, you subtract the original issue price of the unit and also subtract any amount from that unit that was already taxed under this section in earlier years.
So basically, it taxes the distribution less your cost and less anything already taxed.
Precisely. If the cost plus previously taxed amounts exceed the current distribution, the taxable sum is zero. It aims to tax the actual profit distribution from these trusts that hasn't been taxed before.
Okay. Now, what if someone is letting out machinery, plant, or furniture, or maybe a building that's sort of inseparable from them, like a fully equipped workshop? Is that business income, PGBP, or IFOs?
That depends on the primary activity. Sections 5 and 46, 2 and 3 clarify this. If letting out machinery, plant, or furniture on hire is not your main business, if it's just incidental, not a core PGBP activity, then the income is taxable under IFOS.
And the inseparable building.
If letting out a building is inseparable from letting the machinery, plant, or furniture, like a fully furnished studio, a specialized factory space, a cinema hall with projectors, then the entire income from that composite letting is also taxable under IFES. If the building could reasonably be let out separately, its rent would normally go under the income from house property head.
Could you give a practical illustration of how that income calculation would work under IFS, including deductions? Seeing the numbers helps.
Certainly. Let's imagine someone leases out a factory building along with its plant, machinery, and furniture for $50,000 per month. That's an annual rent of $6,000 under IFS.
Okay, 6 lakh income. What can they deduct?
Section 57 allows several deductions against this type of IFO's income. For example, current repairs to the machinery, plant, furniture, say $15,000. Insurance premiums paid against damage to that machinery, plant, furniture, say $12,000. Normal depreciation allowance on the machinery, plant, furniture could be significant, say $1,047,500. Even specific costs like legal fees to the lease agreement, $1,500, or a factory license fee, $1,000.
What about past depreciation that couldn't be absorbed?
Ah, yes, a key point for this head. Unabsorbed depreciation from previous years related to these assets, say $2,075,000 carried forward, can also be set off against this IFO's income.
So it helps utilize past allowances.
Exactly. You total up all these deductions and subtract them from the 6 lakh rent to get the taxable IFOs. But remember the disallowance rules, too. If, say, $25,000 interest on a loan related to this was paid in cash to a non-resident, that $25,000 deduction would be disallowed, increasing the taxable income.
Right, the cash payment rules apply here, too. Okay, what about interest on securities? Is that always IFOs?
Generally, yes. Interest on securities is taxable under IFOS, as per Section 562, unless it's specifically chargeable under PGBP.
When would it be PGBP?
The main example is for a banking concern. For banks, investing in securities, even non-SLR ones, as per Circular 18/2015, is considered part of their core business of banking. So their interest income from these securities is taxed under PGBP, not IFADS. For most other taxpayers, it's IFOs.
Are there any exemptions for interest under IFOs?
Yes, Section 1015 provides several important ones. Interest on post office savings accounts is exempt up to $3,500 for individual accounts, $7,000 for joint accounts. There are also exemptions for interest on certain specified bonds, like those from IRFCL, NHAI, RECL, etc., interest on specific government deposits for employee retirement benefits, Bhopal gas victim compensation interest, gold deposit bonds, and bonds from local authorities. You need to check the specific conditions for each.
And finally, the ultimate catch-all within this catch-all head, residual income. What's left that falls here?
That's simply Any income that is chargeable to tax under the Act, but doesn't clearly fall under any of the other specific head, salaries, house property, PGBP, capital gains, or the specific IFOS clauses we've discussed. It's the literal residuary definition.
Any common examples?
A classic one, which often surprises people, is the salary received by members of Parliament, MPs, or members of Legislative Assembly, MLAs. Because they aren't considered employees in the typical master-servant relationship sense, their remuneration is taxed under IFOs, not under the salary's head. It really shows how broad IFOs can be.
Okay, we mentioned casual income earlier, lottery winnings, game prizes, and now specifically online game winnings, too. What are the actual tax rates? Are they just added to regular income and taxed at slab rates?
No, these types of windfall incomes get special and, frankly, quite high tax treatment. They're not taxed at normal slab rates. Hashtag 7.1 casual income, Section 115 BB. For traditional casual income winnings from lotteries, crossword puzzles, races, card games, other games, gambling, betting, but specifically excluding online games, which have their own section now, Section 115 BB applies a flat rate of 30%.
Flat 30%, plus cess and surcharge.
Yes, plus any applicable surcharge if total income is high enough, and the standard 4% health and education cess on top of the tax. And remember, the critical point we discussed. No expenditure or allowance can be claimed against this income. No Chapter ZISCI deductions either, and you can't even use your basic exemption limit against it.
So win 1 lakh, pay 30,000 tax plus cess, etc. Straight up.
Pretty much, yes. Very straightforward, very high rate. Hashtag 7.2 online games, Section 115 BBJ.
And for online games, there's a specific newer provision, Section 115 BBJ. Why was this separated out? Is the treatment different?
Correct. This was introduced specifically to address the boom in the online gaming industry and provide clear taxation rules. It covers net winnings from any online game. It was likely separated for clarity and potentially for specific reporting or TDS requirements related to online platforms.
And the tax rate and restrictions?
The tax rate is exactly the same, a flat 30% plus applicable surcharge and cess. And the restrictions are also identical. No deduction for expenditure or allowance, no Chapter VSA deductions allowed against it, and no adjustment of the basic exemption limit.
So same tax treatment, just a specific section for online games.
Essentially, yes. The section also includes definitions for internet and online game to clarify its scope, covering games accessed via computers or mobile devices online. It highlights the focus on taxing income from this specific digital activity clearly.
Okay, while knowing what's taxed is vital, understanding what deductions you can actually claim against income from other sources is equally crucial for taxpayers. What are the key deductions available under Section 57? How do they apply to the different types of IFO income we've discussed?
Absolutely. Section 57 is where we find the specific allowable deductions that can reduce the taxable IFOS. Hashtag 8.1 general deductions and specifics for income types. Let's start with dividend income, and this is important. This applies to regular dividends, not the deemed dividend from buyback of shares by domestic companies post-October 1st, 2024.
Okay, what's deductible against regular dividends?
Any interest expenditure incurred specifically to earn that dividend income is allowed as a deduction. However, there's a cap. The deduction is limited to a maximum of 20% of that dividend income included in your total income.
20% cap on interest expense, and for buyback dividends.
As we noted earlier, for the deemed dividend from buyback of shares, no deduction for expenses is allowed at all, 0.
Right. What about interest earned on securities? Any deductions there?
Yes. For interest on securities taxable under IFOS, you can deduct any reasonable commission or remuneration paid to a banker or someone else, specifically for the service of realizing that interest on your behalf, like collection charges.
Okay. And those employer contributions to welfare funds that the employer collects?
If an employer recovers contributions from employees for things like Provident Fund, which initially gets taxed as income for the employer, they can claim a deduction for it under Section 36(1), but only if they actually remit that collected amount to the respective fund before the statutory due date under the Relevant Funds Act. It encourages timely compliance.
And for income from letting out machinery, plant, furniture, and those inseparable buildings, what specific deductions apply there?
For that specific IFOS income, several deductions are allowed. Current repairs to the machinery, plant, or furniture. Insurance premiums paid against damage or destruction of that M&P or furniture. The normal depreciation allowance applicable to that M&P or furniture. And, as we saw in the example, very importantly, unabsorbed depreciation from previous years related to these assets can be carried forward and set off against this income.
Now, the family pension deduction sounds quite unique, different from a regular pension. Can you explain that? How does it work and what's deductible?
It is quite unique. Family pension is that regular monthly amount paid by an employer to a family member after an employee passes away.
Okay.
A specific deduction is allowed against this income under Section 57. It's a sum equal to 33 and one-third percent, 32 to 13% of the family pension received, or a fixed amount, whichever is less.
What's the fixed amount? Does it vary?
Yes, it depends on the tax regime. For those opting for the optional tax regime, under 115 BAC, the fixed limit is 15,000. For those under the default tax regime, the limit is 25,000. So it's one-third of the pension, or 15,000, 25,000, whichever is lower.
Interesting. Is this deduction available under both tax regimes then?
Yes, importantly, this specific family pension deduction is available under both the default tax regime and the optional one.
Are there situations where family pension is fully exempt?
Yes, there are specific exemptions. Family pension received by the widowed children nominated heirs of armed forces, members who died in operational duties, is fully exempt under Section 1019. Also, family pension received by family members of government employees awarded top gallantry awards, Param Veer Chakra, Mahavir Chakra, Gir Chakra, is exempt under Section 1082, hashtag 8.3, the general wholly and exclusively rule.
Beyond these specific deductions, is there a general rule for other expenses, something like the wholly and exclusively principle we see in business income?
Yes, exactly. That principle extends here too. Any other expenditure, provided it's not capital in nature, that is laid out or expended wholly and exclusively for the purpose of making or earning the income chargeable under IFS, is generally allowed as a deduction. It's the catch-all for legitimate revenue expenses directly linked to earning the IFS income. Hashtag 8.4, interest on compensation, enhanced compensation.
And just to reiterate, for that interest on compensation or enhanced compensation, the part taxable under IFOs, what was the specific deduction again?
For that specific interest income, the interest due to delay in payment, there's a specific flat deduction of 50% of the interest amount. No other deductions under Section 57 are allowed against this particular income stream. It's just a straight 50% cut. Now, while knowing the deductions under Section 57 is good, it's equally vital, maybe even more so for staying compliant, to know what you absolutely cannot deduct. Section 58 lays out these specific disallowances against income from other sources. These are strict no-go areas. Hashtag 9.1, personal expenses and payments outside India.
So what's top of the list for disallowances? Personal expenses, I assume, and what about payments going outside India?
Absolutely. First off, any personal expense of the assessee is disallowed. Tax deductions are for earning income, not personal spending. Second, payments outside India trigger scrutiny. Any interest chargeable to tax in India but payable outside India is disallowed if tax hasn't been paid on it, or crucially, if tax has been deducted at source.
TDS.
TDS is key for foreign payments. Yes. Similarly, any payment taxable in India as salaries, if it's payable outside India, is disallowed unless tax has been paid or deducted at source. These are fundamental rules to prevent income escaping the Indian tax net via foreign payments without accounting for tax. Hashtag 9.2, excessive payments to related persons and cash payments.
What about those rules we see in business income, like paying too much to a relative or making large cash payments? Do those Section 40A rules apply when calculating IFOS too?
Yes, they do. These disallowances, largely originating from Section 40A, are specifically extended to apply to the computation of IFOS as well.
So excessive payments to relatives.
Disallowed. If you make a payment to a related person, as defined in 40A, for an expense, the assessing officer can disallow the portion they consider excessive or unreasonable compared to the fair market value. It stops people from inflating expenses paid to relatives to reduce tax.
And the cash payment limit, $10,000.
Yes, the same rule applies. Any payment, or aggregate of payments, exceeding $10,000 made to a single person in a single day is fully disallowed if it's not made by account paid check, account paid draft, ECS, or other prescribed electronic modes, like UPI, net banking cards, etc.
So that $25,000 cash interest payment in the earlier factory example would definitely be disallowed here.
Precisely. It violates this $10,000 cash payment rule, so the deduction would be disallowed under Section 58 red with Section 40A. These rules encourage transparent banking channels, hashtag 9.3, the 30% disallowance rule for TDS defaults.
There's also that significant 30% disallowance rule for TDS defaults on payments to residents. How does that work under IFOS?
This is a major compliance stick. 30% of any sum payable to a resident on which tax is deductible at source, TDS is disallowed if either 1. The tax was not deducted at all, OR. 2. The tax was deducted but not paid to the government on or before the due date for filing the income tax return under Section 139(1).
So failing on TDS for payments to residents can cost you 30% of the expense deduction.
Exactly. It significantly increases your taxable income. However, there is a proviso, a relief clause.
What's the relief?
If you, the payer, failed to deduct or pay the TDS, but you're not considered in default because the payee, the person receiving the payment, has included that income in their tax return, paid the tax due on it, and you furnish an accountant certificate confirming this,
Then you're okay.
then it's deemed that the tax was deducted and paid by you on the date the payee filed their return, and that the 30% disallowance doesn't apply. It provides an escape route for genuine errors if the tax ultimately reaches the government via the payee. Hashtag 9.4 special rule for casual income. Resources exception.
Finally, for casual income like lottery winnings, we said no deductions are allowed. Is there any exception at all to that rule? You mentioned racehorses.
Yes, generally for casual income, lotteries, betting, games, etc., Section 58 is very strict. No deduction for any related expenditure or allowance. Full stop. But there's a very specific exception carved out. This prohibition does not apply to the income of an assessee who is the owner of racehorses, specifically from the activity of owning and maintaining such horses.
So racehorse owners can deduct expenses.
Yes. For that specific activity, they can deduct related expenses, even if they don't earn any stake money, prize money, in a particular year. And if these deductions result in a loss from owning and maintaining racehorses, that loss can even be carried forward under Section 74A. It's a unique carve-out recognizing horse racing as a distinct activity.
Okay, last section. Deemed income and recoupments under Section 59. What's the core idea here? How does it prevent past deductions from becoming untaxed benefits later on?
The principle is quite simple. It's about clawing back tax benefits if the situation reverses. Section 59 essentially says that the logic of Section 41, which deals with recoupment of previously allowed expenses or liabilities, often called remission or cessation of liability in the context of business income, also applies to income from other sources.
So how does it work for IFOs?
The rule is, if you were previously allowed a deduction under IFS for a loss, an expenditure, or some liability in an earlier year, and then in a later year you actually receive an amount back related to that loss or expenditure, or you get some benefit because that liability ceases or is remitted.
Like a refund or a debt being waived.
Exactly. Then that amount received, or the value of the benefit obtained, is deemed to be income under IHS in the year you receive it, or the benefit accrues. It ensures that if an expense reduced your tax in the past, but you effectively get it back later, that recovery gets taxed. It prevents a double benefit.
Phew. That truly was a comprehensive deep dive, wasn't it? We've meticulously unpacked the often complex world of income from other sources, covered everything from those intricate deemed dividends.
And how companies might try to distribute profits indirectly.
Right, to the detailed gift taxation rules under 552X, and that whole evolving landscape of insurance policy proceeds with the new thresholds.
You've definitely gained crucial, really granular insights, not just into what is taxed, but maybe more importantly, why it's taxed.
Yeah.
We looked at the legislative thinking behind the anti-avoidance rules and drilled down into the specific conditions for exemptions and deductions. Getting those details right, payment methods, case laws is absolutely key, both for compliance, obviously, but also for effective planning, especially when facing those tricky application-based questions.
We covered specific numbers, those thresholds, the nuances of terms like accumulated profits or what exactly counts as property for gift tax, even some of those fascinating court cases that shape these rules. It feels like remembering those small points, those details, is what really lifts understanding from just knowing to, aha, I get it.
Absolutely. And as you continue learning, think about how these other sources interact more broadly. How does a deemed dividend loan impact the shareholder's overall tax? How do those gift rules look beyond just family transfers to scrutinize business deals? Connecting these concepts deepens the understanding.
So what does this all mean for you, our listener, who's stuck with us through all this detail? It means you're now equipped, hopefully, to look at these diverse income streams with a much sharper, much more informed lens. You're ready to spot those hidden tax implications, understand the why, and navigate these complexities with, hopefully, a lot more confidence. Keep digging, keep learning, and we'll see you next time for another deep dive.